Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are working on the short exercises that were assigned from the digital study guide for Chapter 8. Come on. All right, there we go. All right, note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you do not understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still do not understand the concepts, then either email or telephone an instructor to get help with that understanding. Okay, so let's see here, we're on 8.7, okay, and this one is about depreciation methods. At the beginning of the year, Titan Trucking purchased a used Kenworth truck at a cost of $48,000. Titan expects the truck to remain useful for 4 years, 800,000 miles, and to have a residual value of 8,000. Titan expects the truck to be driven 160,000 miles the first year and 280,000 miles the second year. So, right, compute, number one, compute the truck's first year depreciation expense on the truck using the following methods: straight line, units of production, double declining balance. Show the truck's book value at the end of the first year under the straight line method. Right, so I'm not going to get into a detailed explanation of how to doing these depreciation methods. If you need a refresher, obviously it's covered in the textbook. Go ahead and watch the textbook, but I'm going to, and also go back and watch the theory videos, because in the theory videos it points to under the business group on the student community, right? So if you're on the student community, obviously watching this video, so, and you know where the business group is because this is where this video is located, right? So under the business group, you'll also see the math for business / applications section, right? Which is right above the financial accounting, right? And in the math for business application section, I forget which chapter it is, so scroll on down, but that's where I cover in video format extensively, the theory and how to calculate straight line, units of production, and double declining balance. So if you need a refresher on these methods, or if you didn't, have math for business before, sure, read the textbook because it explains the depreciation, but you can also go back to the math for business / application section and watch the videos, and also work through additional homework problems in the math section, covering the various depreciation methods. So like I said, I'm not going to go into a lot of detail here. I'm just going to kind of like work through the different methods here. So as far as straight line is concerned, right, so it has a cost of $48,000. It's going to be used for 4 years or 800,000 miles, has a residual value of 8,000, right? So if it costs 48,000 less our 8,000 for our residual value or salvage value, that means we're going to end up depreciating $40,000, okay? And if we're depreciating it for 4 years, that means we're going to depreciate it for $10,000 a year. Okay, so for straight line, that's going to be $10,000. For the units of production, okay, we basically have the same thing. We have the 48,000 less the 8,000 for residual value, or salvage value as I like to call it. So we have $40,000 is what is going to be depreciated. However, when we're talking about units of production, okay, we have the $40,000, and we're going to divide it by how many units that were guesstimating it's going to be used for. So that ends up being 800,000. So in order to get a per unit cost, so 40,000 divided by 800,000 gives us, come on, gives us 0.05 per unit. Okay, per unit. That's our cost per unit. Now, in the first year, right, the truck expects to be driven 160,000 miles in the first year and 280,000 in the second year. So if it's being driven 160,000 miles in the first year, and we multiply it by our cost per unit, 160,000 times the 0.05 gives us $8,000 for our units of production. Okay. Now, double declining balance. Okay, so we're looking at our first year for 4 years, okay, and we're multiplying that by 2, right, because it's double declining, so that gives us 50%, right? And then we take the 48,000 and we multiply that by the 50%, and that gives us 24,000 for our depreciation for double declining balance. Right now, I had said I wasn't going to go into the theory behind this, right? But I'm going to just quickly deviate for a moment here, because if you will recall, for the straight line in units of production, we had started out with 48,000, and then we subtracted our residual value of 8,000, and we're going to depreciate $40,000. That's the basis for the straight line and the units of production. But right here for the double declining balance, notice I did not do that math. I didn't subtract the residual value. And the reason why is because we're using the double declining balance, and we're going to depreciate the full amount, but as we depreciate for each and every year, let's just say this is 24,000, and let's say this is 12,000, so that's 36,000, right? I'm just making this up here as to the amounts, but 36,000, okay? Now in this, in the third year, okay, we're only going to depreciate 4,000 more to get to the 40,000 to have the $8,000 residual value, okay? Because we're looking at that, wherever that limit is in whichever year that it actually applies to, and using the declining balance. That's why we don't take the 8,000 out originally, because it's an accelerated process of depreciating an asset, and therefore we use the full value when we're figuring out the percentage that we're going to depreciate by. And we keep on doing that until we actually get to the point where we're actually hitting our full cost. Now notice here, I said 4,000. That's because I'm at 36,000 here. I'm not going to keep on, even though my next depreciation might, let's just say it's $6,000 for year 3. Well, I'm not going to depreciate the full 6,000 because I'm going to go past the 40,000. I'm only going to end up taking the portion of it during that particular year. All right. So just be aware of that. And again, I'm not going to get into a lot more of this, but go back and watch the theory videos for the math in order to get a more full explanation of the double declining balance. Okay. But I just wanted to point it out because it applies to this particular problem here, and it just sort of stuck in my head because some of you may be questioning, why am I using 48,000 instead of the 40,000? Because it's the method that's being used that says I use the full value of 48,000. Right, number 2, show the truck's book value at the end of the first year under the straight line method. Okay. Okay, so my book value for the truck, let's just say, call it a truck, will be my 48,000. That's my entire purchase price, right? That's my cost. And then I'm going to have my less my accumulated depreciation, which for straight line was $10,000. Okay, so my actual book value ends up being 38,000. That's what my um, balance sheet will look like, and my book value will be this here, 38,000. Okay, so it's my the value of the asset less whatever we depreciate it in the first year. It will give me that book value. Okay, so that's it for that one. 8-8 again is depreciation. Okay, and this is for the second year. All right, so let's just continue on. All right, since I've already done all of the math for the previous one, and for 8-7. And so it says here, refer to the data for 8-7, compute second year depreciation expense on the truck using the same methods. Okay, so for a straight line, it's the same $10,000. I mean, that's what straight line is about. It's going to be the same amount each and every year. So we know it's 10,000 for straight line. Okay, now for the units of production, you know, we still have the same kind of math. You know, we have the 48,000 less the 8,000 for the residual value or book salvage value, which gives us the 40,000. Okay, and remember the 40,000, right, was divided by 800,000 units, which gave us 0.05 per unit, right? But now in the second year, we're depreciating at 280,000 miles, right? 280,000 miles. So 280,000 times 0.05, and that gives us 14,000 that we're going to depreciate for the units of production for the second year. Okay. And then of course for the double declining balance, all right, now remember, again, let me erase some of this to make this kind of clear, because I went off on that little bit of a tangent. Right, so if you recall, this is what we did for the first year for the double declining balance, right? And we ended up with 24,000 for the first year. Okay, so now when we come to the second year, I mean, we know that we're going to, for double declining balance, we're going to use 50% because that's what we calculated. But now the whole idea behind double declining balance is you're taking that 50% of the remaining book value. So I started out with 48,000 as my book value of the unit of the truck, right? And after the first year, I depreciated it the 24,000, right? So I have 24,000 as my new book value, right? And if I have 24,000, so remember this was year one depreciation. So now I have 24,000, and this here is going to be my second year depreciation. So if I have 24,000 and I multiply that by 50%, that means I have $12,000 for the depreciation for double declining balance for year number 2. Okay, and again, just you know, since my numbers actually worked out in year 1, 2, 3, and 4, all right, you know, I started out with 48,000 less my 24, right? Which means I ended up with 24. Now in year 2, we're at less 12,000, so I have 12,000 left in year 2. And remember, we're we're just going to keep on doing the same thing for year 3, and then if we have to, we do it for year 4 until we get down to where we're at. We've actually have $8,000. So 50% of 12,000 is going to be 6,000. So my numbers were pretty good for just in guessing. Well, actually not guessing, but thinking it through. In year 3, I'm going to end up depreciating 6,000, okay, or want to depreciate 6,000. But remember, I only want to get to 8,000 as a salvage value. So I can't take the full 6, okay, because the difference between these two is 4,000. Okay, so I'm not going to be able to depreciate 6,000 for the year 3. I'm only going to be able to depreciate 4,000 for the year 3. And again, all of this was covered under the Math for Business / applications section of the business group. So if you're not understanding it from the textbook, go back and watch those videos, and watch the theory videos in that for that particular chapter, and then even watch some of the worked out problems. If you still don't understand something, then feel free to telephone and speak with an instructor.